Welcome to AKSHARAHA, an initiative by Anvation Educational Trust. In today's class, we are going to learn about net present value, its meaning, types, and problems on NPV. If I promise to give you 1 lakh rupees after 3 years, is it equal to 1 lakh today? No, because money has time value. So, how do companies decide whether a long term investment is really profitable after considering time value of money? That's where net present value plays a role. Now, let's go with the definition of NPV. NPV is a technique that determines the present value of the future cash flows. So, NPV determines the present values. NPV is a technique that determines the present values of future cash inflows and cash outflows related to an invested project. In simple words, NPV tells us how much extra value an investment adds today after adjusting future cash flows to present value. For example, if we invest rupees 1 today, is that equal to rupees 1 tomorrow? No, right? That's because inflation, risk, and opportunity costs. So, NPV converts all the future cash flows into today's value and then compares it with the initial investment. So, how do you decide which NPV is better? So, if NPV is greater than 0, then you have to accept that criteria. If NPV is less than 0, then you have to reject it. Now, let's move to types of NPV calculation. There are 3 types of NPV calculation. Single period NPV, where you have only single cash inflows. Multiple year uneven cash flow, where you have multiple years, it might be several years, and also uneven cash inflow. The initial investment is the same, but the cash inflows what you get might differ from 1 year to another year. Investment with operating cost and residual value. So in these problems you'll add extra 2 points, which is operating cost and residual value. Residual value is nothing but scrap value. So now let's move with the problems. A project requires an initial investment of rupees 1000 and returns rupees 1170 in 1 year. So this is time or N. If the rate of return is 10%, what is NPV? This is PV formula. We don't use this here. We use the formula of NPV. So NPV is equal to cash inflow whole divided by 1 plus R to the power of N or T. Minus initial investment. So now let's substitute. What is cash inflow? It's 1170 divided by 1 plus what is R? What is R here? 0 point. It's 10%. We usually do 10 divided by 100. So this gives to 0 0.10. We'll take 0 0.10 to the power of how many years? 1 year. So this is the time. So 1. What's the answer? One 70 divided by 1 plus 0.10 to the power of 1. What's the answer? So it's nothing but 1170 itself. 0.1 you will get, I think so. So this initial investment of rupees 1000 did profit 1170. So this initial investment of rupees 1000 returned as 1170 in 1 year, and including the rate of return of 10%, it didn't give any profit. So now let's calculate NPV 1170 minus initial investment, right? We have not done this. What is the initial investment? It's 1000 rupees. So what's the difference amount? It's 170. So this 170 rupees is the NPV. 0.1 minus 1000. One one 70 divided by 1 plus 0.10 to the power of 1 equals 1 point, sorry, equals 1170.1 minus 1000, that is initial investment. So what's the answer? It's 170.1. So this is the profit. Is this profitable? Does this answer satisfy the condition that NPV should be greater than 0? Is this NPV is greater than 0? Yes, right? So you accept this project. That's it. Now let's move with the second question. Multiple year uneven cash flow. A project's initial investment is of rupees 10,000. Expected cash flow is 10,000, 25,000, 30,000, 35,000, 40,000. And what is the discount rate? It's 10,000. Now let's move on with the problem. In these problems, you have to start the year with 0, where you did your initial investment. So 0, 1, 2, 3, 4, 5. You have to start the cash flow from the initial investment. It's minus 10,000. This one. Now start the from first year. What's the first year inflow? It's 10,000. Second year it's 25,000. Third year it's 30,000. Fourth year it's 35,000. And fifth year it's 40,000. Now this is nothing but discount rate at 10%. How do you calculate discount rate? We use the formula, right? PV is equal to 1 divided by 1 plus R to the power of n. We should use this formula to calculate. So dr is equal to 1 0.10 1 divided by 1 plus 1 0. Okay, so you'll get that out how it came 1.10, 1 divided by 1.10. 1 divided by 1.10. What's the answer? It's so for the first year we have to put 1, and for the second year it's 0.9090, and for the third year just press equals. You'll get the answer by automatic itself. 0.826 for the third year. Again press equal. It's 7.13, and for the fourth year 0.751, and for the fourth year it's 0.683, and for the fifth year it's 0.621. Now let's calculate PV. PV is nothing but cash flow into discount rate. So you have to multiply this. That's it. So minus 10,000 into 1. What's the answer? It's nothing but minus 10,000. 10,000 into 1 is nothing but 10,000. 10,000 into 0.9090. This is the first year interest. It's 9,090. It's 9,090. Let's calculate second year's 25,000. 25,000 into 0.82, sorry, into 0.826, right? So what's the answer? It's 20,650. Let's move to third years. 30,000 into 0.751. 22,530. So like that we have to calculate fourth year's 23,905, and for the fifth year it's 24,840. You guys calculate by yourself, or else we need a plenty of time to finish this. So NPV is equal to, add this everything, summation. So what's the answer? It's 91,015. Now we have got NPV. Let's calculate it. NPV is equal to summation of cash flow, right? Cash flow minus initial investment. So what's the cash flow? It's 91015. And what's the initial investment of this project? It's 10,000, right? So 91,000 minus 10,000. So what's the answer? 81,000. So what's the answer? It's 81,105. So this is the NPV. Does this NPV satisfy the criteria of NPV should be greater than 0, or NPV should be lesser than 0? Which condition does this answer satisfy? NPV is greater than 0, right? So this is accepted. Let's move to the third problem. Investment with operating cost and residual value. Calculate the NPV of two projects. Suggest which of the two projects can be accepted, assuming a discount rate of 10%. So what's the initial investment of project A? It's 50,000. And what's the initial investment of project B? It's 60,000. Estimated life of the two projects is 5 years. And the scrap or residual value is 5,000 for project A and 10,000 for project B. Expected cash flows for the year 1 is 10,000, year 2 is 25,000, year 3 is 30,000, year 4 is 35,000 and year 5 is 40,000. Now let's solve the problem. Project A. Year CF at 10%. This is discount rate and PV. So for the year, I said we have to start from 0, 1, 2, 3, 4, 5. And here there is one adjustment, extra point, which was scrap value. So what did they say? Scrap value was at the 5th year, right? So we have to take another 5 here. So the initial year, we have to take the initial investment amount. It's 50,000. Next 10,000, 25,000, 30,000 for third year, 35,000, 40,000, and for the 5th year, last one, you have to take the value of scrap value. What's the value of scrap value? It's 5,000. Let me write it. Calculated in the problem. For this, we have to take 1, 0.909, 0.826, 0.751, 0.683, 0.621, and for the 5th year, same, we have to take 0.621. This should be same. Now, multiply it. So what do we get as answers? For the first year, it's minus 50,000 as usual. For the second year, it's 9,090. For the second year, it's 20,650. For the third year, it's 25,530. For the fourth year, it's 23,905. For the fifth year, it's 24,840. And for the 5th year, it's scrap value 33,105. Now, add this. Add everything. You'll get NPV. NPV is equal to 54,120. That means 54,120. So, cash flow, summation of cash flow minus initial investment, right? Do you remember this formula? Initial investment. What's the cash flow? 54,120. What was the initial investment of this problem? It was 50,000 of project A's, right? So 54,000 minus 50,000. It's 4,120 is the difference. Does this satisfy the condition NPV is greater than 0 or NPV is lesser than 0? it satisfies the condition of NPV is greater than 0. So we accept this problem. Now let's move to the project B. Project B. Here CF at 10% discount rate. P. Again calculate 1, 2, 3, 4, 5 and 5. So CF is 60,000, 1, 60,000. 10,000, 25,000. For third year it's 30,000. For fourth year it's 35,000. For fifth year it's 40,000. And what's the scrap value? What's the scrap value of this? It's 10,000, right? So let's take 10,000. Rate of interest is 0.900, 0.909, 0.826, 0.751, 0.683, 0.621 and 0.621. Now multiply this. So we'll get 9090, 20,000, 650, 22,000, 530, 23,000, 905, 24,000, 840 and 6,210. Now add this. So you'll get 24,695. So summation of cash flow minus initial investment, right? What's the cash flow? 24,695. And what's the initial investment? It was 60,000. So what you will get the answer as minus 35,000. 305. So this is in minus. So does this answer satisfy the condition of NPV should be greater than 0 or NPV is lesser than 0? This satisfy this second condition. So NPV is less than 0. This 0 is in positive figure, but the answer is in negative figure. So NPV is smaller than 0. So we reject this. So we accept the project A but reject the project B. So this completes your NPV. Thank you for watching our channel. Subscribe for more content like this. Thank you.